Looking ahead, we have the Fed's preferred inflation gauge, PCE inflation, to look forward to on Friday. Now, our next guest says we have a long and winding road to the Fed's 2% inflation target. Joining me now is Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Thank you for joining me this morning. So talk about this long and winding road and how it's going to look at this point, given that markets, they seem to now be somewhat at least believing the Fed's trajectory from here.
Yeah, I think that the Fed or the markets have really bought into the idea that the Fed is going to hold rates about where they are for the foreseeable future because inflation is going to head towards 2%. Now, the problem is that's probably not until 2026 that we get there. So between here and there, it is likely to be a bumpy road. We know that energy prices have already gone up very materially. In the last inflation report, the energy component was up 5.6% for that single month. Now, when we look ahead, it's likely not going to continue to rise at that pace, but there is an upward bend towards that type of inflation, that source of inflation. So you've got energy, possibly auto costs also going up as far as the UAW strike. What does that do in terms of supply chains, the price of used cars and new cars? So over the next few months, we are likely to see some almost reversal of the improvement that we've seen so far on the inflation front. But we do believe we will get to 2% inflation. It's just there might be a little bit of pain to get there.
And Brian, speaking of pain, obviously you have a looming government shutdown. Some analysts believe that could perhaps take a rate hike off the table, depending on how deep it goes. What is your estimation of perhaps how the government shutdown might perhaps lessen the load for the Fed going forward?
I think that it's not necessarily the government shutdown, because in the typical one, that would only shave off like fractions of a percentage point of GDP growth, because oftentimes what happens is people still get paid, they still consume, but then services might get disrupted only in a protracted shutdown. We believe that it is going to be a more protracted shutdown that we see this time, unlike the ones that just lasted over a weekend or even just over a week. So this could be a multi-week process, in which case the economic pain could just very slowly build. Our bigger concern here at Annex on our investment committee isn't necessarily the government shutdown. It is that consumers seem to be moving from what we called profligacy, so kind of spending a little bit more than what they otherwise would, to austerity, where they're already seeing interest costs rising, pulling back on non-essentials. And so it's really that consumer trajectory going from the profligacy to austerity that has us on high alert for maybe the peak of economic activity was in the third quarter, and now it's going to be a slow slide a little bit lower for the next few quarters here.